On today's episode, we're going to dig into what's really driving MSP mergers and acquisitions right now and why platforms and operating models matter more than headlines and multiples. We'll look at how private equity, venture capital, and AI augmented roll ups are changing the rules and what that means for independent providers deciding whether to buy, sell, or stay put. And we'll get practical on diligence and integration because in managed services, the deal isn't won on the term sheet, it's won on the execution. Abraham Garver joins me today. It's Wednesday, January 21st, 2026, and I'm Dave Sobel. Welcome to the Business of Tech Lounge, the live version of the Business of Tech podcast. We'll take questions and comments throughout the show, so please make sure to submit them in the chat. If you have a question, we will happily respond to it. Now, thanks to ABC Solutions, a Business of Tech Plus supporting vendor. ABC Solutions specializes exclusively in accounting, supporting managed service providers and IT firms. Check them out at abcsolvesit.com. And our live stream support is provided by Rhythms, delivering 5G connectivity solutions for MSPs. Reliable internet access for everyone. Visit rythmz.com for more information. Remember, I am watching the chat, and I'll take questions in real time. Now, Abraham Garver is an MSP-focused investment banker and managing director at Focus Investment Banking, where he leads the firm's MSP practice and advises owners and investors on mergers, acquisitions, and valuations in the managed services market. Over the past several years, he and his team have advised on dozens of MSP transactions, helping multiple MSPs evolve into new private equity-backed platforms. Before joining Focus, he worked in Merrill Lynch's M&A Technology Group and Ernst & Young's Business Valuation Group. And he's an active industry commentator and conference speaker who's been published widely, including contributions to outlets such as Forbes, and he is a frequent guest on this show. Abram, welcome back to the show.
Hi, how's it going, Dave? I'm delighted to be having a conversation with you.
Oh, I'm always excited to have you on because you really do have the pulse of the mergers and acquisitions portion of the market. And, you know, one of the things that I'm kind of looking as we talk about 2026, the thing that I'm sensing is that M&A is really no longer just about buying revenue. It's about buying operating models. And increasingly, it looks like it's buying a path to scale and standardization and automation. Now, I kind of want to get your sense when you're looking at today's MSP deal flow. What are the biggest misconceptions that owners have about what buyers are really paying for?
Gosh, it's, I think it's helpful to just kind of describe and say there are really three markets going on. There's private to private, there's private to a private equity, and then there is private equity to private equity. So we're, as this consolidation, which really got going in 2020, as it continues to go on, they're very distinct kind of buckets of, I call it like when you say what's going on in the M&A market, I really think, of three markets, and then objectives of the different players that are in each markets. And historically, it's been, founders, CEOs, started with an operating, a PSA like ConnectWise, and grew their business, joined peer groups, and became pretty successful. Backtrack to 2020, private equity saw all of this recurring revenue and said, hey, this would be a great investment for our funds that we've raised. And started basically investing into you can only really get so much like operationally mature and large on your own without institutional money. And many of these companies, had kind of peaked at, let's say, $4 or $5 million of EBITDA, the founder CEO kinds. And private equity has just really changed everything that's going on. Let me pause there for a second and have you reframe.
Yeah, I mean, it's so because I'm really curious. Like, what are the common platform value pieces that buyers are looking for? Like, when they're examining these pieces, is it pricing power? Is it technical details of service desk efficiency? Is it cybersecurity posture? Is it particular verticals, or is it something else I'm not even thinking of when I think about where they're investing in the platform value levers?
it's very ironic, actually. I kind of, until I saw this happening over and over and over again, it's it's largely a function of how big the fund is that they raised. So somebody that raised a $500 million fund is going to look for three, maybe four of EBITDA. Somebody that's got $1 billion fund is going to look for 5 to 6 million of EBITDA, which is kind of where these, on their own founder CEOs were not really able to get beyond that level. And then we have much larger funds that have come in, and they can only buy things that are 10, 15 million of EBITDA or more. So they're looking, I'd say that's the big point. Number one is a lot of this is just driven by the size of these funds and how much they have to deploy. But then more kind of tactically, they're looking at are these, as the consolidation has continued, we've gone from MSPs doing M&A and just kind of buying revenue, other MSPs that aren't really growing, to now buyers are really, and this is where I think they should be, they're focused on how many new logos is the MSP, like how many new customers is it getting each year. A quick example is like one of the platforms we did added 33 new logos or customers last 2 years ago. And when the private equity invested, it was, even if they did a face plant, that business would still add 25 new customers. Versus if you buy an MSP and it's got no growth, it's a very different long-term trajectory.
So I want you to clarify a little bit for me the meaning of like just the amount of money they have, because I will admit my slightly cynical take on that is well, they just have money and they're just throwing it around, and that feels a little indiscriminate. I don't think you mean it to imply indiscriminate, but maybe you do. Like, tell me a little bit about the relationship between sort of the size of the fund and how they're executing against it.
Yeah, let's use the $500 million example.
Okay.
That's really what a lot of these private equity groups in 2020 had. They had 500
Okay.
million, and they told us we're going to make 10 platform investments with this 500 million. 50 were earmarking for MSP, 50 were earmarking for HVAC plumbing, and kind of so on and so on for the other eight. So you just take the fund, kind of the simple math is take the fund amount, divide by 10, and that's how much they're going to deploy in the platform. So maybe 50% of that, 25 million, would be the first investment. And then they'll use the other 25 million plus leverage to do more add-ons and help it grow organically.
Gotcha. Okay, that makes a little bit of sense the way they're thinking about it. And the other thing I was interested in is you're hearing founders ask sell or reinvent. I kind of want to get your take a little bit on what does that mean, and then what decisions increase the choices either way. Give me a little bit of your perspective on sell or reinvent.
Yeah, well, I was kind of flabbergasted. One of our clients last year, and they traded at the end of this past year, said, and he had started at age 21 and built an MSP for 25 years, and kind of the terminology a lot of people use is curb jump. Um, as the market changes, as the MSP market changes, kind of from the founder CEO chair, there have been many cycles of kind of we have to reinvent, we have to plow more money back into the business to kind of still be around at some point in the future. And this client of ours last year was one of the first people to say this to me. An extremely bright, successful person, built the business to 25 million of revenue. And he just said, I don't want, AI is not something I want to take on my own. And when you think about it, we've got they're really like four top buyers at this stage. And some, like as an example, have 400 million of revenue, 100 million of EBITDA. And in my opinion, they're in a better position to take 1 or 2% of sales and invest it into AI and kind of how to be, kind of the most competitive in the future versus, especially if we go down, we've got a $3 million MSP of revenue, 4 million, 5. They don't have, if they take 1 or 2% of revenue, and say, I'm going to dedicate this to AI, it's kind of meaningless. So as we go through time now, there's going to be a larger and larger kind of separation between these um, bigger MSPs and what they can do with AI. And everybody else is kind of left saying, I either need to reinvest, which if they do that, their EBITDA is going to come down. And some people may say their valuation will come down. It's a curb jump. Like founder CEOs are stepping back right now. It kind of started, call it a year ago, but some people that lead very influential groups are saying kind of to their maybe peer groups or other groups, it's this could be a really good time for you to sell because it's going to become more and more competitive with these larger businesses.
That's really interesting to immediately that curb. I like the thing about it as a curb jump. It's very much related to AI. I'm intrigued by also that an owner who sort of said like I put a lot of time in this and I'm not ready to make the next lump. Do you have sense, particularly because you're talking to a number of these platform companies, do you have a sense of how much the AI curb jump is going to cost? Capital, people, execution. Like, do we have sense around that? And then how quickly we think this is going to ramp up among the MSPs and the platforms that you're having conversations with?
We'll really model that out, on a case by case basis for people. I look at it as just like any other capital expenditure. It's like CapEx, and it's a, it's the kind of like net present value decision. Do I invest more at this point to earn more in the future? And the, the capital, I think it's going to, I think a lot of people should really be out, to the extent they can use a third party for the AI automation, the ConnectWises, the Kaseyas, some of the specialists in automation. I think that's a better use of time, unless you're one of these top 4 largest MSPs kind of on the front line and have the need yourself.
Gotcha. And we certainly know that with the math alone tells me that most of the listeners are not the top 4. So I know that we definitely have math on our side there. Like, so
Yeah.
when you're doing diligence on these AI and automation stories, what proof convinces you? Like, is there particular items, elements, things you can look for, and are there triggers that have immediately raised skepticism?
So there are I think two come to mind, like two vantage points. One is one of those top 4 largest. They're looking at, they're looking at the target saying, have they figured something out? Are they doing something that we're not already doing? Is there some value here for us? And the answer 9 times out of 10 is no. That they're that larger kind of entity is more sophisticated. Yeah, does that, I don't know, can
Yeah,
you reframe that again?
yeah, of course. So, because
There
one
was
of the
that one.
things, yeah, I mean, one of the things that's interesting to me is everyone's throwing around AI, right? Like I mean, like I can pick on the vendors really easily, and every single one of them will tell you that they are AI enabled. You're spending a lot of time talking to MSPs on like both sides of a deal, right? And you're trying to understand how much of an AI or automation story is real. Like how much of this is actually real versus hype or marketing or just noise. I'm reasonably confident you've talked to enough of these that you've got like, yeah, I know if I see these 2 or 3 things, their automation story is actually real. Or if I see these 1 or 2 other things, that is your BS detector goes off very quickly, and you're like, that is all real. Can you give a sense of on both sides of that equation, like what makes AI real and what makes it not?
From the buyer's perspective, I like the analogy of a patent. Like somebody may come and say, "Hey, I've got this patent, and it's
Okay.
worth $5 million." And I would say back, if in the financial statements that the patent holder has, it's generating, let's say, 750,000 of EBITDA as a result of the patent, I agree with you. And it's kind of the same way here. The buyer is really just looking at the financial statements. So, like, if something's going on with AI, I think it's pretty lumpy to make AI investments for like a smaller MSP and have there be any meaningful. There's so much noise in the financials. I don't see that AI at this point is really materially making one 5 million 1 5 million revenue MSP worth more than another 5 million um, revenue MSP. Like, prove it by having better financials. That's
Gotcha.
where it really counts. That's where it counts. So I'm not as, I'm into the tech stack. We're into the tech stack. The buyer's into the tech stack. But there's nothing that's really materially moving anything in the smaller businesses because they just don't have the, it's a great question for the person buying the $100 million EBITDA business that's been investing in AI. How has this been changing things? We saw there was one that traded. There was an MSP that traded that was, let's see, financial services vertical focus, 50 million of revenue. It had zero of EBITDA because they had been spending like 7 million a year on AI prior to ChatGPT, um, and other sorts of things. And when it came, the sponsor wanted to get out of the investment, um, and they had no EBITDA. So it was like they spent a lot of time, energy, money, and there was nothing there to sell. You had to just basically, if
Hmm.
it doesn't prove out financials, it's not worth anything.
Gotcha. And so it's really interesting. Again, does come back to the financials, but what you're also sort of encoded in that is there's very large organizations are making very
Yeah.
particular investments. But I'm going to remind everybody on my service leadership date on this, 81% of the space does less than $10 million in revenue. So that means in most of that space, it's not actually happening. And so it's a really kind of an interesting distinction to draw the line there. I want to actually sort of highlight, and thank you to Aditya who's watching. It's kind of nice to have that reinforcement. And if you've got a question, make sure to throw it into the comment section. Now, I also want to get a little bit of a sense from you, Abram, on like the pre-diligence step judgment. Like, oftentimes before diligence even starts, there's processes where buyers decide whether an MSP is a future platform or just an add-on. Are there particular signals that you're looking for in that portion of the process that make it easy to kind of sort people into the two buckets, and what are they?
Yeah. So for platforms, they really need to be $3 million of EBITDA. And part of that goes back to what we were talking about, the size of the fund. And it's also the private credit lenders. If there's less than 3 million of EBITDA, they're not involved, and it's too small for them to be involved. Um,
Okay.
that
That,
so your question was about kind of buyers seeking platforms or add-ons and deciding.
yeah.
So, as an example, this client that opted not to make the AI curb jump, they qualified to be a platform from a size perspective all day long. Um, they could also sell as an add-on to like one of those top four largest buyers. Uh, and so you're really, just having bespoke conversations with, for us, kind of in that process, we had 87 signed NDAs, so 87 buyers out of a field of about 200. And we, you know, the top five, like the winner, and then the other, let's say, four runners up, we're going to be in our next processes, we're having bespoke conversations, the next asset that comes at that size with the, kind of runners up and winner in previous processes, having those kind of water cooler conversations. Is this, you've told us your criteria, you've updated us with your acquisition criteria um, for 2026. Here's what the asset looks like. Here's some more color on it. Are you a go or not on it? And it's really, we want to get onto the front line with each asset and have those conversations. And, probably 50% of the transactions don't go through a broad process. 50% are, like a platform buyer or a strategic buyer have been pounding the table for, and I'm thinking of an asset that's in Atlanta that's in a certain size. And so when we get it, boom, we go to them, and they're, you almost really don't need to run an auction because they're going to be in the top one or two anyway.
Gotcha. Now I got to ask a little bit. You mentioned the tech stack, and I'm curious about that. I also want to lump that a little bit in with some security. Are there top one or two technology or security risks that kind of often derail the value, particularly as you go into close or post close?
It used to be something that was looked at closer. Many of the transactions are asset sales, and so liability associated with, like, if someone were buying equity, may be different. And I tend to look at, like, I think a lot of us were really excited about like security kind of MSSP services, 3 years ago, 4 years ago. And really today, it's table stakes. And that new, when somebody had an existing client base and they cross sold or upsold security services, it looked like they had nice organic growth, but it was just a one time event to get your existing client to now be taking add-on security services. And that's just not as valuable as someone who can, I call it print new logos, can bring in new customers over and over and over again. So as I think about, somebody's got an MSP, it's 5 to 10 million of revenue. What should they do? Should they try to, take this AI curve jump, or should they look at, are they really actually worth more to somebody else's business that's further along and is already kind of, you know 2/3 of the way through the AI curve jump and has money committed to it going forward.
Gotcha. All right. Well, we're going to blast a couple of questions. I want you to
Absolutely.
take out your crystal
Yeah.
ball. I definitely want you to take out your crystal ball here, and I want to get a couple of things that you see coming. Like, do you, as we look out over the next 12 and 24 months, are you expecting changes in the way deal structures are done, or are we going to be looking at everything very consistent execution? Like, do you think things are going to be changing over the next year or two in deal structures?
I think these top four are going to win. I think they're
Good.
going to, I mean, I'll give you an example. Like in let's say it's like a $5 million EBITDA business. One of those four buyers can give there's $750,000 of EBITDA from synergies that they can get. And people describe it as like below the line, like in G&A, there would be two people doing the same job when they make the acquisition. So those four buyers can look at a 5 million of EBITDA, and really they're going to gain 5,750,000 versus all the other. So I see those buyers valuations can be higher from that group, and I see all the others at a disadvantage because, like, a new private equity group looking for a platform that doesn't have an MSP, Um, Historically, those had been some of the highest. Those have been some of the highest valuations and bidders, but they now can't compete because they have to look at 5 million of EBITDA as 5 million of EBITDA. It's not 5,750,000.
They're not getting the benefit of the rounding error for sure. So
Yeah.
let's get the kind of my last question. I really want to get a sense, like, what's the biggest, most widely repeated assumption in MSP mergers and acquisition right now that you think is just absolutely wrong? Like, what's the one misconception you want to sweep away for everybody?
This, I haven't said this before, and I really feel this way. Like many of us, the service leadership valuation multiples and kind of they're updated every year. I think those are a relatively good guide. There's a lot of nuance that's in there that can make someone really be up at the top when, but just assuming that everybody's at the median of what's there, here is what people don't know and don't see. um, and it's I'm we go through the we go through the process with these private equity groups. We've had 13 platforms, transactions with 83 uh, parties, buyers and sellers. I am flabbergasted at how many of them retrade or what's called reprice at the end of, in like 2 weeks before close. They bring up it. This is not what we thought we were getting from the LOI. And anybody that's doing a transaction, if it's happening to us, um, as the M&A advisor, I would, I'm impressed that people will continue to get value, like get a letter of intent at the valuations that are in, service leadership, give or take. Um, but I am not convinced that they will close at that number because they're going to get retraded. It could be 20% lower. But I would say we see it 6 out of 10 times. And I think if you're not advised, it's probably happening 9 out of 10 or 10 out of 10 times. People don't know about it. And unless you've seen the games that the private equity groups play, and can play offense on it when the letter of intents, and we can, talk more about this, play offense on it, people are going to continue to get creamed on that because it's the private equity group. They're in the business of buying companies, and this founder CEO is doing this one time.
So I definitely want to ask a little bit more about that because I want to make sure I heard it right. People are making adjustments post letter of intent, like particularly for those that are not familiar with the process. And listeners, I literally just did this myself, so I'm quite familiar. You oftentimes go early. You can go an indication of intent, saying you're indicated. A letter of intent generally is this is our offer, and oftentimes you're then going into due diligence to get to a closing, but you've established the value at the letter of intent stage. Talk to me about what's going on. Are they making adjustments pre-letter of intent several times, or are they doing it post-letter of intent based on due diligence? Talk to me about what they're playing with.
Yeah, so it's really post letter of intent. Post letter of intent. The letter of intent, for example, in one we worked on, said we need in our buyer quality of earnings, we need to see X amount of, we need to find X amount of EBITDA in the latest 12 months. Our client, came through, had that much EBITDA in the latest 12 months, and the buyer said, "Oh, I want the run rate. I want the run rate EBITDA to be this number." And we're like, "Well, that's not in the letter of intent." And the reason, and the run rate is just is the latest 3 months times four. So, for instance, somebody might have a sold less product in that 3 month period, and their 3 month EBITDA is lower than expected. It gets multiplied by four, and the buyer says, "Look, I was buying the business based on the run rate EBITDA, not your LTM." And so, getting in front of or you lost two or three customers. There was a story. This was back 3 years ago, 3.5 years ago. Somebody lost two, three customers. It was 200,000 of recurring revenue, um, not EBITDA, 200,000 of recurring revenue, and the buyer forced a $2 million haircut on the valuation um, right before close for losing those customers. So you got and if you've got 100 customers or 75 or 50, like something's going to change between signed letter of intent and close. So customers are a big one. Forecast. If you put a forecast out and you miss the forecast, forget if you got the right EBITDA amount. You missed the forecast, and therefore we're going to reprice. So like there's just a list of things that are going to happen. You really want to get out in front of it. So I would say people get the headline LOI number, give or take with what service leadership is putting forward, but they're not closing at that number.
Right. But I want to differentiate between two different things, I think, in the scenarios you just talked about. So the first is, so you put in a letter of intent, you've got a number based on that. The due diligence is to prove that it's there. And if you said in
Yeah.
my letter of intent, I have based this, this valuation on this data, this is how we came up with it, this is how we do it. And so the due diligence process is for the seller to prove to the buyer this is actually there, so that they agree on that. But what was interesting to me is you said something about the fact that it wasn't in the letter of intent. So, for example, if we've established that the value is done based on this, this information, that's how we do it. But that's not in the letter of intent. Talk to me a little bit about how the dynamic of that plays out. Because the reason we write things down, as my lawyer always reminds me, is contracts save friendships, right? The idea is that you write it down so that you've defined it. If it isn't written down in the letter of intent and it shakes out differently, isn't that how the deal would then theoretically fall apart? Talk to me through about how that dynamic works.
So really, like kind of in the old days, and kind of what the protocol really should be, we all say, the buyer and the seller, and the advisors, here's our letter of intent. Valuation is going to change between signed letter of intent and close. Like things can happen. I've had somebody add 80,000 in MRR, like between signed letter of intent and close, and the value of the business definitely changed. What everybody historically has done is said, gentleman's agreement. If the value of the business goes up or down by 7% or less, we're all going to trade at what we agreed to in the letter of intent. Now, I'd say in reality, it's really, we're not going to ask to reprice or retrade like as an advisor unless the values change more than 10% between signed letter of intent and close. And um, we're also going to say Focus will not earn any more money on any incremental gain, um, from repricing. Like we want to have no conflict of interest. It's just the right thing to do if the business is now worth 10% or more than when we signed the letter of intent. Um, but I gotta tell you, it was just kind of disappointing the number. Like we did a number of transactions last year, and there it's helpful to work with us and kind of others that have done a lot of these with a lot of buyers, because we know who is going to, like, the certainty to close on the terms that were agreed to in the letter of intent. There's some buyers. I mean, I would bet, I'll, not staking my life on it, but like they do what they say they're going to do over and over and over, even when it's inconvenient. And those are the buyers that when we force rank, 87 signed NDAs, 10, 11, 12 offers, this buyer has never repriced before, versus this buyer's repriced twice.
Mm-hmm.
Like you're just, it hurts you. they can get away with it in the short run with us, but then they're not seeing more deals. They're not getting it. We're not gonna pick them again.
Right. Well, you always
And
come with such good advice, and that last one's encoded there, particularly if you're on the seller side. Work with a broker, work with somebody who understands the process, because as you just said, the buyers, particularly in this space, do it a lot. They're very good at it. And if you only have ever done the one side as the seller, you need an expert to guide you through that process. Abram, it's always such
yeah,
fun to talk to you about this stuff. If
thanks.
people are interested in following up and learning more, is LinkedIn the best way to get in touch?
Sure, LinkedIn works great. Yeah.
Great. We put your LinkedIn handle there up on the screen. You're at Abe Garver. Garver. Find you on LinkedIn. I so love having you on the conversation.
Yeah,
Look
I
forward.
love talking to you.
Well, thanks for joining me. I'm looking forward to having you back again in the future.
Awesome. See you soon.
And I also want to highlight an interview that's dropping this weekend. I was joined by Rob Calvert, and we discussed the alignment of technologies with how people actually work. And he emphasized that effective IT solutions should be an asset, not an obstacle for businesses. We were talking a little bit about how workflows work, and he gave some real insights in the way his organization, particularly focused on the Apple ecosystem, helps organizations deal with onboarding and workflows. Here's a preview of that interview. Can you walk me through how the process works in practice for a new client, particularly one who may not even know what their workflows are?
Sure. So we're working with a company now that, excuse me, is a service provider, and they have their own technology platform, and they have employees all across the country working on hardware for municipalities as well as private companies. And in getting engaged with them, they had a CTO, and he was working hard on cleaning up their technology side of things. What was very difficult for them was the challenge of managing all of their devices, knowing who had which device in which state, what condition that device was in, how old it was, et cetera, et cetera. And so what we found when we started working with them was they had no regular procedures or standards set for when they were hiring or terminating folks from their staff. So every decision was being remade in the context of that particular position, which meant that there was a lot of leadership time and energy spent on the decisions of hiring and terminating folks, or when someone was exiting voluntarily. So what we ended up doing was working with them to establish what are all the platforms that a new employee needs, and organizing that based on the role within their company. The engineering team needs different things than the sales team, who needs different things than the operations team. So we mapped out all of their various technology platforms. Once they gave us administrative access, we went in and we audited each one of these platforms. And we said, okay, give us a new hire. And they gave us their first onboarding. And so we had to walk with them through every department and saying, what does this person need in this platform? And we helped them establish standards and baselines that every new hire would need based on what their role is going to be. That meant a lot of questions, a lot of decision making, and a lot of documentation, and a lot of fine tuning of, we can do that, but if we do it this other way, it's actually going to be more efficient. So can we make this the standard, and then design an onboarding form that allows you to deviate from that every now and then? And the key is, if they do deviate, to know why they're deviating, and to set an end date for that deviation, or at least a revisit date, so that they don't keep skewing away from these standards that we're working with them to create. And the end result was, after about 3 onboardings, we had a very fine-tuned standard set of permissions, access, account types, and everything all designed for them. And now, instead of taking 8 or 9 hours to do an onboarding, it takes about 3.5. And then we follow that exact same procedure with someone exiting the company, deciding where the security gaps are, how to make sure that the company's protected, that the intellectual property is protected. So we work with them to figure out, how do you retrieve a device? At what point do you lock someone out of a cloud system? What do you do with their data? Which data needs to be archived? Who needs access to it? And how you grant it in a practical way that allows staff changes to not isolate data and hide it from the leadership of the company, or to leave security gaps open because they've given too much permission to other people in the team to someone's data. So we just have to go through that process. It's a wash, rinse, repeat. until you get it fine-tuned and documented in a way that now says, okay, 90% of your onboardings and 90% of your offboardings now have a standard set of rules and processes to follow. And it's only those edge case 10% that you actually have to have conversations to fine-tune.
We talk a lot about the idea of building workflows. Rob and his team are doing it and gives real practical guidance on the way to implement it in your business. Business of Tech Plus subscribers get interviews early in the dynamic ad-free feed. It's a benefit of supporting the show. Visit businessof.tech/plus to sign up and get early access. The interview will be released for everyone on the weekend. And thanks to ABC Solutions, a Business of Tech Plus supporting vendor. ABC Solutions specializes exclusively in accounting, supporting managed service providers and IT firms. Check them out at abcsolvesit.com. Our live stream support is provided by Rhythms, delivering 5G connectivity solutions for MSPs. Reliable internet access for everyone. Visit rythmz.com for more information. And vendors, you too can get your name mentioned on the live show. It's part of our vendor support level for Business of Tech Plus. If you'd like to support the show and get even more from the Business of Tech, check out our membership options at businessof.tech/plus. There's a free tier with access to daily stories and transcripts, insider access for bonus analysis and early access to interviews, and the leadership tier with exclusive vendor briefings, data reports, and behind-the-scenes insight into the channel. Every membership directly supports independent reporting and helps me continue bringing you research-driven coverage of the IT services industry. Again, that's businessof.tech/plus. If you have a question or are listening to the recording, send it in at question@mspradio.com or put it in the comments on YouTube. Thanks for joining me for the Business of Tech Lounge, and I will see you next time.
Part of the MSP Radio Network.